Well, markets took something of a pause for breath last week, with consolidation the main theme of proceedings after the central bank bonanza to kickstart February, and of course ahead of the big week of data we've got coming up this week, including the eagerly anticipated US CPI print on Tuesday. Nevertheless, there are signs that the tide is starting to turn in favour of dollar bulls, with the market now paying increasing attention to the Fed's higher for longer rhetoric as data shows signs of moving from hard landing to soft or even no landing, depending on which way you look at things. As I said, it's a busy week ahead. We've got US CPI number. We've also got a busy economic calendar here in the UK. And who knows, we might even have some UFOs thrown in the mix as well. It's another big show on the Trade Off UK this week. So without further ado, let's get into it. Well, there's certainly some UFOs buzzing around in the United States, but let's hope the aliens keep their hands off this show for the next half an hour or so at least. Without further ado, let's welcome my co-host, Ryan Littlestone from Forex Flow and Forex Analytics. Ryan, how are you doing? Good to see you again.
Yeah, not too bad, mate. With all this alien activity, do we need to ask security questions between each other to make sure we're dealing with one another? We haven't been taken over.
If either of us turn green or go a funny colour at any point during this recording, then I guess we know what's happened. Let's get into it. Lots to discuss. So let's get Topical Thunder underway. Well, UFOs aside, the main event of the week is undoubtedly the US CPI number that we've got coming up on Tuesday afternoon. Just to get the expectations out the way early doors, headline inflation expected at 6.2% on a yearly basis. The core number expected to rise by around 5.5% year on year. I know we're going to get into inflation and discuss that in some detail in a moment, but personally, I would say that the risks to this are tilted to the upside, given the PMI surveys and other sentiment data coming in showing a bit of a resurgence in price pressures, and also the fact that the inflation basket itself has actually been rebalanced, which saw some fairly chunky upward revisions to the inflation data towards the tail end of last year. I really think that it is the core number we should be paying attention to, Ryan. I don't know about yourself, because now that the market is starting to believe this higher for longer message that we're starting to get from the Fed, perhaps that a hotter than expected core number will really kick the bond bears into life even more than we've seen already.
Yeah, exactly. It's going to be difficult, this number, because the trend has been obvious for now 8-9 months since the middle of last year. Inflation's been on the way down. The core's been a little bit more stubborn behind it, as it tends to do. It does tend to lag behind the headline number. So if we get a headline number that's, round about expectations, but something different in the core number, the market will trade the core number. But it really is a binary event here. Is inflation going to continue going lower? The risk is, as you say, if we get a stronger print, maybe an unchanged or even a higher print, that's really going to upset the apple cart, because, we've had the pivoters coming in, they've traded it. Now we're just starting to see the Fed hawks taking over, those traders pushing yields up, and, I don't think we're out of the woods with the inflation here, and I think it's going to be a difficult number to trade. You have to react to it. I'm certainly not picking a side going into it.
No, I think that's the absolute key, being nimble as and when the data comes out, or even sitting on the sidelines while the market digests everything and then going back in once the dust has settled a little bit. But it is interesting that I think the market itself is starting to position for a beat. If you look, the dollar has rallied quite significantly over the last couple of days. The dollar index closing north of its 50-day moving average on Friday for the first time since, I think, November last year. And yields also rising quite significantly as well. The 2-year Treasury north of 4.5% for the first time since November. So as far as the market's concerned, I think investors are positioned for a hot number.
Yeah, exactly. And, if we know the risk going in, we know where the bigger price risk is. Depending on where the market's expecting, we know how to judge the moves thereafter.
Yeah, most certainly. Well, speaking of risks, I know you wanted to talk about inflation as well, but particularly the potential second round effects from the bout of inflation that we've seen over the last 18 months or so.
Yeah, definitely. And this is going to be a big subject. I mean, even just before we start this video, there's a story out in the UK, all the mobile phone companies, broadband companies, going to be boosting prices, by record amounts coming into the next couple of months. And, central banks have mentioned it briefly, that second round effects. A lot of them don't see any big, the Fed talks wage price spirals and things like that. But there's certainly aspects coming into the market, into the data, and certainly what we're seeing on the ground, where these, price pressures are going to start building again in different areas than were before. We've seen services, like you mentioned, the PMIs, getting a bit of a divergence between the services data and the manufacturing data again. And services inflation is something that the Fed is particularly hot on. The Bank of England's mentioned it as well. No doubt the ECB will be on it. So I think over the next few months, we may see a few central banks getting a bit more cautious about the second round effects coming in, getting a bit more worried. We've already started to see some victory laps coming in from central banks. Powell talking about the disinflation process has started. People talking about peak inflation. We may have had the peak, but it doesn't necessarily mean we're not going back up again.
Yeah, I think you're absolutely right. And actually those sort of comments we're getting from central bankers are starting to worry me a little bit. I think Andrew Bailey, the BOE governor, had some similar remarks last week when he was testifying in Parliament, effectively saying, we're not taking a victory lap. Well, how can you when inflation is above 10% here in the UK? But we're pretty happy that things are moving in the right direction. Well, let's not count our chickens at this point, because these are the same central bankers who, of course, spent the entirety of 2021 going, this inflation, these price pressures, it's temporary, it's transitory, it's not going to last particularly long. And, well, bang, look where we are now. The other thing I wanted to mention, just in terms of second round effects, particularly here in the UK, but I think this is going to start to become an issue elsewhere, is wages. And particularly when you look at industrial settlements. I mean, pretty much half the country seem to be on strike on any given day here in the UK at the moment. At some point, these disputes have got to be resolved. And these unions are being offered 9-10% pay rises, and, they're being rejected. So we are potentially going to see those pay settlements go even higher. And as a result of that, maybe we will even see a resurgence in inflation as a result. And just to carry on from that point, it is a big week of UK economic releases this week. We've got the latest labour market figures due Tuesday, inflation, all eyes on inflation on Wednesday morning, and then retail sales wrapping things up on Friday. And I think it's going to be an interesting data slate, because you're again going to see probably a relatively tight labour market coupled with inflation that's coming down, but a core number that remains sticky above 6%, while retail sales are likely to remain very, very weak again. So perhaps, and I don't really want to support them, but perhaps you can see why some of the MPC members at the Bank of England are being a little bit more cautious, because I don't know about you, Ryan, but one, that data doesn't paint a great picture for the economy, and two, it doesn't give me much cause to want to look at long sterling positions at the moment.
No, very much so. But, a lot of people write the UK off at their peril. We do have a way of being resilient, and you've got it there. Temero last week, already plotting rate cuts. And then today you get that story about how broadband services and mobile phone services prices are going to rocket through the roof. And as you say, we've got wage negotiations going on with the unions. They still haven't come through yet. So this may be something that feeds into the latter part of the year. We've still got energy price rises here in the UK. And yeah, you look at the Bank of England, I've said it for a while now, they're going to be caught on the hop. They think rates are only going to get up to maybe 4% if they're lucky. They're already looking to maybe pause. They're going to be forced to go higher. And I'm still putting that marker at 5% for those guys there. So I think it's
from the BOE.
Sorry?
5% from the BOE?
Yeah, they're going to 5%. Yeah.
Yeah, that's a bold call.
I think if we don't see UK rates at 5% because of these inflation pressures that are going to keep coming through, because it's the way with the UK. We're heavily reliant on imports, and if you get price pressures from there, it comes right in. They stay for a long time. They feed into the core, the domestic prices, and we find inflation getting much higher as well. Grocery food prices still hitting record highs month after month after month. It's not going away just yet.
Well, no, I agree. I think inflation is here to stay. And even, of course, if the inflation rate starts to roll over, prices aren't going to roll over anytime soon. That's for sure. But 5%, that is punchy. I mean, I think just from memory, the market is looking for a terminal rate of what, 4.35, 4.4%. So 60 basis points above that, that's got to be, if it were to happen, that's going to be some pretty chunky sterling upside if that would come about, isn't it?
Yeah, possibly. But then who would have thought we'd see central banks hiking at 75 pip clips for months on the trot? So, we're in a different world than we were before. We've had, nearly over a decade of low inflation and inflation not getting very high. Now it's on the rise and it's here to stay. And I think it's going to be too soon for central banks to think the job's done just because they see a few months of inflation rolling over.
Well, that is very true. I did see a call last week for a 6% Fed funds rate as well. So, certainly it is becoming, not only higher for longer is becoming the consensus, but even higher than we thought for longer than we expected might become the consensus relatively soon. Somewhere where that is probably unlikely to happen, and I'll hand over to you to go through the details, is Japan. What's going on with the BOJ?
Right, well, we might finally get a bit of a conclusion to tomorrow morning, early in Asia hours, around 11 a.m. Tokyo time. It's about 2 a.m. UK time. We get the nominees for these positions at the Bank of Japan. And obviously we got thrown a curveball last week with someone who's been an old previous member at the Bank of Japan, Kazuo Ueda. And he's been thrown into the frame by the press. There's not been a denial of that from any officials as yet. So he looks like that was a bit of a bomb drop there in Japan. It was funny watching the market react. The market react, was digging around. They all went searching on Google to what he was doing, what's his view and everything. And they came out with a conclusion that it's not going to be another Kuroda Mark II. Amamiya also seemed to rule himself out. So that put a hawkish slant on things, and we saw yen pairs dipping quite significantly. But then when people did some digging and found out what he was really about, and then apparently the press were knocking on his door and phoning him up, he came out basically saying that the Bank of Japan policy, the easy policy, is right at the moment, and we saw the yen turn right around. So we still need a confirmation on that, I think, because we may yet get another curveball in this scenario. But once we get that, then the market's going to make its move in terms of the yen, where it's going to go, pricing hawkish or dovish, the same old, if you like. And then we move into the period where both houses have to hold hearings, confirmation hearings, and he gets questioned and we hear further answers. So we'll get that over the weeks ahead. But finally getting to the end of this path and knowing who's in the hot seat is going to be a big mover tomorrow.
Yeah, it'll be nice to finally get a bit of clarity on that. And actually, I've got to say, I really appreciate the Nikkei dropping those reports at 7 o'clock on a Friday morning, literally as I stepped off my train at London Bridge. And I did get quite a few strange looks as I was sort of fumbling through my phone to work out what the hell was going on, as I think most other market participants were, because, most people, either they'd heard of Ueda and forgotten about him, or hadn't heard of him at all, and suddenly had to scramble to work out who this bloke actually was. I think the big takeaway from me, though, is actually that, well, one, Amamiya said no to the job, which is perhaps a little bit surprising, given that, he's the deputy governor. Why would he not want that promotion to the top job? Is it sort of, too scary and too much of an ask, and he knows how many problems could potentially be caused by the BOJ coming out of this sort of couple of decades of ultra easy policy. And then I think actually the fact that Ueda's come out so rapidly and said, actually the current policy stance is appropriate, that's also a little bit surprising, because it's clearly quashed some expectation that we are going to see a more rapid transition to a quote-unquote normal policy stance from the BOJ. And I think that's obviously going to be a headwind for the yen, even when he's confirmed. And with Treasury yields on the rise as well, things are starting to perhaps look a little bit less rosy for those who are bullish on the yen. But I don't want to go on to yields too much, because that's the first chart I want to discuss in the next section. So let's get on to that's a setup. The rogue flashing police light is almost as rogue as some of the UFOs that have been flying over the United States, I think. Right, let's get into it. The 10-year yield, that's what I want to start off this week. nothing else you can really start with, to be honest. When everyone's looking at inflation, everyone's thinking, how is the CPI number going to impact the Fed's policy outlook? You've got to look at the bond market, you've got to look at the Treasury space, and obviously the 10-year is the benchmark that we all look at. We're pretty much in the middle of the recent range at the moment, around 3.7, 3.75%, which is quite an interesting level because we've sold off fairly notably from the 3.4% lows that we saw towards the start of the month. That's largely driven by the blowout payrolls number and the ISM services PMI print as well. So now that it's kind of this tug of war between the bulls and the bears has reached perhaps a little bit of a stalemate. And I think if we do see a hotter than expected CPI print, then that recent high, which I think we saw towards the tail end of last year at 3.9%, that's probably going to be in the sights of bond bears if we get a bit of a sell-off. And if we get a cooler than expected number, we're going to come quickly below that pinky purple trend line I've put on there, back towards the sort of 3.6, 3.5% level. And of course, this is important not just if you're trading fixed income or bonds across the curve, but also for other assets as well. The 10-day correlation between the 10-year yield and the dollar index is at 0.8, which is very, very tight, the tightest it's been in quite some time, and effectively means if the 10-year yield is rising, the dollar index is pretty likely to rise to a similar magnitude. And we also see a similar inverse relationship with tech stocks, with the NASDAQ is around minus 0.6 when I last looked. And again, if we see the 10-year yield rise, we're likely to see tech stocks come lower by a similar degree. And that's why I think the bond market, yes, it can be confusing. Yes, it can be a little bit scary, but it is absolutely pivotal, and particularly in this week more than most, no matter what asset you're trading, to have treasuries on your radar.
Yeah, most definitely. I mean, it's a big driver in FX as well. The dollar, dollar yen can walk lockstep with yields as well. And you're right, it is a fine line we're walking here. We're bang in the middle of the range. I still think it's going to take a lot. It's going to take some real heavy confirmation that perhaps rates are going higher to get tens up into that back towards that 4% mark. If we ever get an inkling that rates are going to 6% or higher than 5.5%, that's when we potentially get a move and we shift up a plane in yields. But it's also playful, like you say. We could end up down at those lows, 3.3, 3.4% after the CPI numbers, or we could end up over 3.8 up to 3.9.
Yeah, most definitely. The other thing I wanted to talk about, and this isn't going to become the bond show, don't worry anyone, just before we move on, is actually the 2-year yield has sold off so much more than its 10-year counterpart. And the 2-10s curve on Thursday last week, I think it was, and it pretty much stayed there on Friday. And it's most inverted since the 80s. So although everyone is kind of talking, we're going to get a soft landing, or Wells Fargo had a note out I was reading over lunch, it's not going to be a hard landing. It's not going to be a soft landing. It's just going to be a not hard landing, which, well, to me, that's soft anyway, but whatever. The market isn't necessarily singing from the same hymn sheet as the sell side. And I think that's quite an interesting divergence to keep an eye on over the coming weeks. But anyway, that's enough on bonds. Let's have a look at, what is it, dollar yen you've got coming up.
Yeah, well, dollar yen is one I'm looking at the moment. And we spoke about this one actually last week. So it's a bit of a follow up. We expected some further upside to this pair coming into it, and that's what we got. We got to move up to this one high 132s, 133 area up here, and it's going to move again, obviously on the Bank of Japan. We're still in this box that you can see there, the shaded box, and that's really a range I'll be looking at while things are staying pretty calm, probably 127 up to these 134s, 134.5. Now, what's going to be important in two aspects, depending on your trading time frame, is where we are at the end of the week. We may get moves up to 136 over this. We may get moves, wherever to the downside. If we finish up outside of this box, if you like, maybe to the upside, that's potentially going to push us to new levels. If we don't, it's going to keep this range and consolidation period in play. And that's what I'm going to be looking at. I'm still short in my long-term pot in this one, and I'm happy to stay on the short side, but I have been expecting it to rise, and I won't be surprised if we see it pushing higher. I will start to get a bit nervous if inflation holds up and if the data wholesale starts to turn more positive, particularly in the US, and we got the first of the manufacturing numbers coming this week. Obviously, then the Bank of Japan, if we've got another Kuroda Mark II in play, it means it's going to be a bit longer before maybe we start seeing some easing moves, or some tightening moves from the Bank of Japan. So it could mean that we do see a period of further upside for this pair. Trading wise, it's pretty simple. You trade a level until it's not. If we get up to that 134.50, that's somewhere to look for shorts. If we break above, you want to see the break holding above that before you commit to taking a long on that side.
No, I think that's a really good overview. I think the other thing I would mention when it comes to the yen, and this is more anecdotal than anything else, is sentiment certainly, but I would expect positioning to follow alongside. Seems relatively bullish yen at the moment. And if you do get this sort of Kuroda continuation at the BOJ and a hot CPI number and kind of murmurings that actually inflation may be starting to make a bit of a resurgence in the States, then you could get quite a chunky position on wine to fuel a little bit more upside. So I think that's something worth having on the radar as well. And I'm sure dollar yen, if you're not putting a chart of that in next week, then I certainly will be. It will be a bit of a competition between us who gets to our run sheet first, I think.
Yeah,
but anyway,
let's lines on it.
Yeah, there we go. Who's got the more lines? They can have the chart in. Well, speaking of that, I've actually got my own crayons out this week looking at the euro because the rally in euro dollar stalled out. And it's quite clear that that's stalled out around the 110.35 level. Again, towards the start of the month, the payrolls number, the ISM print, and also the ECB in the mix here as well, with that rather confusing press conference to start February, if anyone can think back that far. We've retraced quite a long way. We're about 3.5% off the highs in euro dollar now, and Friday marked the first close in euro dollar below the 50-day moving average since November of last year. So I think the tide is starting to turn a little bit here when we look at euro dollar in favour of dollar bulls. You've got to remember that the big sort of fundamental driving factors behind that rally that we saw over the last couple of months of 2022 and into January as well were firstly the big upside data surprises we were getting in Europe. Effectively, everyone going, things aren't great, but they're not as bad as we expected them to be. So pricing out that sort of peak pessimism. And the other thing is the market was pricing in a much more hawkish ECB because the ECB came out in December and said, we're going to do 150 bips worth of hikes in 4 months, which the market was not priced for and was not ready for at all. Now we're in a bit more of an equilibrium where both of those factors have been discounted, and actually the tide is starting to turn in favour of the dollar. We're moving away from this hard landing idea towards the idea of a soft landing, data coming in better than expected in the States, perhaps the US economy getting its sort of badge of honour as the cleanest dirty shirt in G10FX back once more. And I think if you look not only at euro dollar, where I'm starting to become a little less optimistic, starting to become a bit bearish and looking perhaps for us to move back towards 105. But actually, you see a relatively similar pattern playing out, even if I could say it, in quite a lot of pairs. If you look at the Aussie, if you look at cable, you look at dollar yen, as we've discussed, momentum does seem to be turning a bit, doesn't it?
Yeah, most definitely. And Aussie dollar particularly, it's turning, which I'll talk about in a moment. But yes, nothing ever goes one way forever. And we've had a strong rally in the euro since late last year. And then it got, as you say, picked up a bit of speed as the ECB turned more hawkish. But now, as most things with central banks, it moves in phases. Now we're in a phase where the market's back looking at the dollar, back looking at the Fed. Are they going to get up? Are they going to stay up? Is it going to be a soft landing, no landing, that sort of thing? And so the dollar buyers have come back in and they've been pushed out of the market for the last few weeks, the last few months even. But now they're just starting to creep back in again. They're getting the upper hand. And, for FX traders, that's good for us. It's volatility that we like. And, you say 105 looks a real juicy level for me. It's a good solid level. If we get down there, test it, hold it, I'm certainly going to be looking at longs down there.
Yeah, I would agree. I think 105 is a really key level that everyone needs to have on their radar. Plenty of vol in FX, but also some vol in the commodity space as well, isn't there?
Yeah, definitely. And WTI is one that I want to look at. We've got a real solid level, or a couple of good solid levels in this one. Firstly, we got, let's call it the bid and bid, if you like, the down into the 70 area where bidding was supposed to be, hoovering up oil after letting all those SPR releases go. We've got a real good double bottom there around in the high 72s there. And on the upside, we've got a very solid resistance area around the old fib, 82.50. And I think the way the market's going at the moment, if the US manufacturing does start picking up, if we're going to see the US economy as a whole, stepping up a gear rather than going down, it's going up, then potentially that's going to be good for commodities, good for oil. Follow that up with China as well, obviously the reopening and what's going on over there. I could see that we perhaps get a decent upside move here, but it's got to get above that 82.50 handle. So perhaps if you're looking for shorts, that's the level you really want to look at. You don't need to, put the house on it. Fairly tight stop. If you get above that 82.50, if we confirm it, I always keep saying about confirming breaks, confirm the break by holding the level as support after a break, then potentially we're heading all the way up to 90 and maybe some of the higher levels we see up there before.
Yeah, I think that's an interesting one. And obviously, I'd make a couple of points. One is that we are starting to see crude gain a little bit of ground. And obviously, one thing that no one seems to be particularly concerned about at the moment, just taking this all the way back to what we were discussing at the start, is the implications that this will have for the inflation outlook. If we start to see commodity prices rally, if we start to see particularly energy prices rally, then that's another dose of inflation coming down the pipeline, which absolutely no one wants to be dealing with. The other thing is that actually you're starting to see the impact of higher oil prices, higher crude prices begin to feed into the FX market once more. The Canadian dollar having another good week last week. I think it's 7th positive week in the last 8. And also the Norwegian kroner and actually Norwegian equities too, starting to gain a little bit of ground as well. So if you are bullish on crude, there are other ways to play it. You can play it through simply outright longs in WTI or Brent, but also the correlations between crude and other assets are starting to reassert themselves as well.
Yeah, most definitely. And as you say, there are other ways to play it. It's funny because we're even seeing crude affected at the fixes recently. And I've never seen a fix in crude in my life, but we get the London fix and suddenly see crude jumping by 40, 50 pips. And you think, what's happening there? Obviously, you got the Russian side of things. That was a big lifter last week. You can see that big candle there when they decided they're going to lop off 500,000 barrels per day of production. So that's still in the mix. Russia's getting under a squeeze with the price caps coming in. So all the evidence builds that perhaps we're going to see the upside more than the downside in this one.
Yes, most certainly. Well, in that case, let's move on to the last segment and have a look at our plays of the day this week. So I think we've both gone for quite similar ideas this week, and it probably doesn't take a genius if you've watched the whole show at this point to work out what they are. We're both looking to get long of dollars, and we're both, I think, looking to get short of risk-sensitive currencies. Now, I've chosen to do that via short cable. I'm looking for cable to move below 120 in the relatively short term. As we discussed throughout the show, the tide is starting to turn back in favour of dollar bulls as everyone moves away from a hard landing and starting to think more about a soft landing. Meanwhile, here in the UK, the data this week is unlikely to be particularly great, particularly on the inflation front. I would say risks are to the upside there, and you've already got growth slowing. Retail sales are likely to be relatively soggy, and the Bank of England are again one of the most, if not the most, reluctant to tighten policy and raise rates in the G10 world. You had relatively dovish testimony from the MPC members last week. Temrero even talking about potentially cutting rates, although she didn't actually say when she would look to vote for a rate cut. From a more technical level, we're below the 50-day moving average once more. We are trying to form a double top as well at this 124.45 level. We need a break below about 119.40, 119.50 to confirm that. But if we did, then the measured target from that is all the way down into the 115s, which may be a target for the medium term. But over the next week or so, I reckon short cable below 120, hot US CPI, dismal UK data, and a reluctant Bank of England. Things are not looking good for the quid at the moment. Ryan, what's your play of the day? I was going to say play of the week.
Well, mine's Aussie dollar, and you don't have to play it in one day. You can play it all week if you like. We're there to trade, so trade away. And I mean, first and foremost, I think we need to put some copyright symbols on our plays of the day, because I've heard rumours of accusations from the other guys doing the other trade-off that we copied some of their ideas. So
well, I thought it was the other way around. I think they've been copying us. We're there first.
Yeah, it is. But you hear these rumours, coming out of Scottsdale, Arizona, where a certain someone is. So we just have to be careful about these things. Get some copyright signs up, as I say. But into Aussie dollar. And this is one I'm going to talk about a lot, probably because I am in positions. I've been following a lot, and when you follow it a lot, you get a little feel for it. Now, I've mentioned in previous videos here and Forex Analytics that I was worried that if we couldn't get back above this 70 level, we're going to be heading lower, and that's what happened on Friday. We poked our nose above the 70 area, got up to 70.10, 70.11, couldn't last, and we've come all the way back down. I think, on balance, there is more downside to come from this one after that failure, but we do have a decent level here around about the 68, 70, 80 area. So that can be your support point at the moment. While we're down here, if we get a break under that, then I'm going to be looking perhaps maybe as a short-term short. I am still long-term long, but I think any rallies into 70 is going to be key. If they hold up there, that's definitely going to be one people need to look at for potential shorts. But if we get a break of that 68, 70, 80 area, it's going to need that confirmation again, because we've tried a couple of times, as you can see on the chart there, getting down to around the 50s before we get a bounce up. So you want to see it come down there. If it bounces off that 50, 68, 50, but then we see 68, 70, 80 holding as decent resistance, I think there's further downside to come, and it could mean we get them over, all the way back down to the 67s, maybe even more.
No, good stuff. Plenty of opportunity then in the market again this week, and a busy week awaits. Ryan, thank you as always for joining me this week. I'm sure we'll have plenty to discuss in the show next week. Thank you also to our producer, Kyriakos, who, although you can't see it, he is rocking a very sharp haircut this week, one that puts Westy's debut haircut that he unveiled in the Trade of Australia last week to shame. Speaking of Westy, if you haven't already seen it, do have a look at the Trade-Off Australia, the original and slightly less good version of the show. That comes out on Wednesday night, Thursday morning, and Ryan and I will be back with you this time next week. Thanks as always for watching, and goodbye for now.